Today we're going to talk about a company which Rakesh Jhunjhunwala bought into in March of 2020, or rather FY21, if I can call it that. 8% stake is what he's bought, Anushi, and he's made a cool 13-bagger on this one. So,
of course, that's the kind of returns that we've seen and we'll be discussing later on this show. What continues to hold the
yeah,
stake?
so WABAG is what we're talking about. If that wasn't obvious, I'm sure it wasn't. But yes, you know, it's always a company of interest when you have someone of that stature, arguably one of the best investors globally, who's bought into it and he's made really good wealth from it. It's been a bit of a turnaround as well, and we'll discuss that. But let's first talk about what I want to know when it comes to WABAG. The first thing I want to know is growth. Well, what they've suggested is they're not focused on top-line growth. In fact, the interesting commentary I read from what the management said is the top line can grow to infinity, but profits can still be zero. That's why we're going to focus in on profitability rather than top line growth. But they still have, Anushi, an order book 4 times the size of their top line. So I'll be curious to know whether there is some kind of an internal target, whether that's FY26, whether that's FY27, when they hope that there is a kicker which comes from the top line as well, because once margins go through, you want that top line growth.
Exactly, and if you just look at the timeline also, they have maintained this 3x to 4x kind of a book to bill ratio. So considering that, what is the kind of CAGR that we can expect for revenue is something that is important to keep a hold of, right?
Yeah, absolutely. So again, so this is the one key piece. The other one is cash flow. Will your FY25 number in terms of cash flow sustain? We've seen a very strong, viewers, this is for perspective, we've seen a very strong growth in cash flow in FY25, and that is because some amount of receivables have gotten cleaned up, right? So that is kind of providing good tailwind to that number. Can that really continue? Or is that something which is part of regular business, and will it be cyclical? Will cash flows have that cyclicality? Of course, an upward trending cyclicality, but a cyclicality nonetheless, where there will be years in which cash flow will not come through. How should we expect that to play out? Because there is another moving part here, which is again of interest, and you know, especially to understand this, the working capital to cash conversion. When I'm looking at the total assets, really it's a very, very light business on assets. But your working capital requirement is extremely large, and therefore can that working capital shift towards, and I'm talking about working capital X cash, can it shift towards cash, and how much of that can shift towards cash? Because if a meaningful component of that working capital, whether it's inventory, whether it's receivables, shifts to cash even gradually over the next 2 years, that can mean substantial amount of cash flow.
Exactly.
For a company of this size.
And while we did see a reduction in this year in terms of where the receivables were concerned and in terms of the improvement in working capital, how sustainable is it going forward, and would there be further improvement is something that we need to keep a hold of?
So we'll try and ask whether there's a number to that. Then, of course, the fifth component is margin levers. They've guided for 13 to 15% margin. They're currently at 13 at the lower end of the band. How quickly does it go to 15? The other one is also the O&M, which is operations and management, as well as EPC, which is engineering, procurement, as well as construction contracts, which is more favorable for them from a margin perspective, and how does that mix play out over the next few years. Last off, I want to understand the margins in Southeast Asia versus Africa versus India versus Europe. And my understanding is the Southeast Asia, Africa margins are much better. Thereafter, it's the India margins, and the least lucrative is Europe. That is my understanding of it, but we'll understand it from the management.
We'll add the Middle East component to this as well, since the company is, bidding for higher projects in Saudi Arabia and other regions as well. So that is another bracket that we should be focusing on.
Correct. So we'll understand all of that. Thank you for that, Anushi, but you want to start off about the company?
Absolutely. So what we are looking at is the WABAG. It is an industry leader in total water management, that is, we are saying. Currently, if you just take a perspective in terms of the project, 6,500 plus projects that we are looking at. So that's the kind of size that we have seen. And this pertains to the various fields that we are seeing. This is across conservation, optimization, recycling, as well as reuse of resources that we are looking in terms of where it is focused on water. So it's a pure water play company, and the management did say that it does not want to deviate from this and wants to remain a pure play water business. That is what we are seeing for VATech. Right, Harsh?
Yeah, absolutely. And let's also understand execution. So they do execution and operation of water and wastewater treatment plants. That's how they typically provide their services. Who do they do it for? Just two broad level clientele. One is municipalities, which is governments and municipalities, and second is industrial. So those are the two pockets of customers they have. Let's talk about presence. They have presence in 4 continents and 25 countries. There you go, and 25 plus countries in fact. But the larger focus is going to be Africa, Middle East, we spoke about it, India as well as Southeast Asia. Those are the larger opportunities that they see at this point. Now, in terms of contracts they undertake, let's quickly talk about all of those. Water treatment, desalination, wastewater treatment, water reclamation. So across the board, sludge treatment and effluent treatment. That kind of sums up the contracts they have with municipalities as well as industries. Effluent treatment is more focused towards industry than municipality, at least at this point. Then they have life cycle partnerships, and these are EPC contracts, O&M contracts, which is operations and maintenance contracts. They also do design, build and operate contracts, and then build, operate, own and transfer. They do all of that. So there's BOOT, there's DBO, all of those contracts is also what they enter into and they cater to. So that's the larger structure of the company and the business. Let me also take you through some numbers as to how the revenue has shaped up, and this will be important because if you want to see that margin shift, you want to understand how the revenue is currently and whether there is changes to that and whether they are following through with regard to the guidances that they are giving. So currently O&M is around 43, EPC is around 57. Let me switch focus to geography. Geography current, okay, municipal industrial. Industrial is around 20, municipal is around 80 at this point. And when I'm looking at India versus rest of the world, this is 38 rest of the world, 62 India. They want this to be 50-50 eventually. That's the goal.
For municipal and industrial, 50-50 is kind of the ratio that we should be looking at.
Okay.
So in terms of where it is currently, so this is the mix that we are seeing, but it would be interesting even in international business, they are eyeing for a higher mix. So we can talk to the management about where in key geographies they're seeing this demand coming in from, right?
Absolutely. So, and the other interesting piece is also the O&M piece because it's recurring revenue and higher margin. So I want to understand that
also
as well.
It's a long period that we are looking at. It's like a 15 to 20 years contract that we are seing. So how they benefit from this. So this is
sustainability.
Exactly. So that is something that we should be seeing.
Perfect. So now let's quickly zoom into the metrics and more keen to talk to the management, but we'll try and break down the metrics as quickly as we can. We'll start off with income statement, balance sheet, cash flow, return ratios, shareholding, street trade, valuations and street coverage. Anushi, income statement.
So firstly, when we look at the income statement, revenue is the first component that we are seeing. We are looking at an overall 3% of a CAGR growth, and this is between 22 to 25 period that we are looking this growth coming in from. FY25 to 24 performance, the growth comparatively better. But overall, in terms of where the order book size is considered, revenue CAGR, now the management does expect about 20% plus growth from next year onwards. But so far, this has been the trend in the last 4 years that we are looking at. Margins, we have seen a particular shift where they have concerned from what was a 8% of a business that has eventually moved to a 13% range, and management is now focused to bring this to the level of 15% is what we are seeing. Net profit, so considering EBITDA wherein the CAGR is comparatively better in terms of the shift which has happened, we are looking at a 22% of a CAGR growth. This is reflected in the net profit as well, where we are seeing 31% of a CAGR. Just want to draw quickly attention to the FY23 picture in terms of where the net profit was. There was a couple of write-offs which had taken place in that year. That is why we are seeing this comparatively a smaller figure as compared to 22, 24 and 25. So that's the bit on income statement that we are looking at overall. But let's also contextualize this with the order book that we are seeing. Now, order book, if we see FY25, it ended with 13,667 crore. This is almost the 4x book to bill ratio that we are looking at. And this has been the trend that we are seeing in the past few years as well, 3.5 to 4 times of range. So now it is interesting now that because it's a 4x of a multiple that we are looking at, how the growth would be for revenue in terms of execution is something that we should be watching out for, right?
Absolutely. Now that we've got a hang of how the income statement has gone, let's look at the balance sheet. In terms of equity, fairly healthy. The borrowing is extremely low. It's around 350 odd crore. When you're looking at the overall cash and bank balance, it's sitting at a very healthy number, but some of that will go into dividend distribution, which they are doing this time around. Now, it's an interesting balance sheet. On a 10,000 crore market cap, on a 5,000 crore balance sheet, then the fixed asset number is just 67 crore. If you heard that right, 67 crore. It's an extremely asset-light balance sheet that I can see. So where is the balance sheet actually balancing? The largest component of this balance sheet is sitting in other assets. And within that, you have inventory, a small amount of 30 crore, but trade receivables, 2,000 crore. Then there's a cash of 1,000 crore. There's loans and advances of 800 crore. And then there is other working capital items of around 1,400 odd crore. So you have these large chunky items sitting in working capital and net and current assets. I want to understand whether this can unwind quickly and make it light from even a balance sheet perspective. But this will also add some color to cash flow, because when you have such a large working capital requirement, cash flow is obviously impacted.
So I'll just talk about how the cash flows have shaped up. Overall, it's a positive trend that we are looking at. 85 CR is the cash flow figure in FY23, which from FY25 we are seeing about 355 CR. So contextualizing that with the EBITDA, we are looking at a growth from cash flow from operations to EBITDA 27% to 84%. Even your net cash flows from a negative figure in FY23, it has moved to 268 crore. So that's the bit on cash flows that we are seeing.
Yeah, so cash flow from operations, more work required. How much of that balance sheet can convert to cash flow from operations is really the question. And then thereafter, all the profits that are coming in, how much of that gets converted to CFO, which is cash flow from operations. Let's quickly talk about return ratios now. A healthy trend last 3 years, slightly difficult before that, 12, 17, thereafter 19, 18. So now it's sustaining at that late teens number. Clearly a thumbs up. Can this continue to sustain given the guidance? Likely. And mind you, the ROC or the capital employed also might well shrink, because you might see a shrink with regard to that working capital requirement, as I did mention, which could shrink the ROCE as well. You want to understand that, but that we will. So return ratios likely sustainable. That's the ROCE and ROE numbers on your screen. Anushi.
Just to add on that, in the outlook that they have given for medium term, they want the ROE to be greater than the 15% of a figure that we are looking at. So interesting to ask about the return ratios that we are seeing. Now, in terms of where the shareholding is concerned, if you look at the promoter stake, in the last 3 years, it's remained at 19%, while it's FIIs wherein they have their stake in the range of 17% to 19% and from 23 to 25 period that we are looking at. DI is comparatively muted stake in the company with about just 3% of a holding. It's the public which has shown the highest interest, holds about 59% of stake from 61% levels at the end of 2025. And what is interesting here is, what we said in the start of the show, Rekha Jhunjhunwala holding about 8% of a stake in the company, and that's from the period of FY21 that we are looking at. So it's been a multi-bagger in that regards for the investor, right?
Brings us perfectly to street cred, Anushi.
Exactly.
Let's pull that one up. The 5-year street cred of this company is a 13 bagger in the last 5 years. Been excellent for those holding the stock, and of course including the Jhunjhunwalas, not surprisingly. But let's talk about the 1 month period. 6% up, 6 months down around 10%. Similar in the year-to-date trajectory as well, not surprisingly. In the 1 year, it's given a 34% return. We'll give this one a thumbs up, because the 1 year as well as the 5 years looks excellent, and likely whether that can sustain or not will obviously be something that we will speak to management about. Valuations, Anushi.
Valuations, current multiple trading at around 32 times is what we are seeing. Comparing the forward multiple, that's the 2-year forward that we have taken in context, that is around the range of 21 times. Now, if you take competitors in comparison to this, their multiple stands at about 25x. So overall, what stance we've given for this is on the neutral side, right, Harsh?
Absolutely. Let's pull up last off the street, the analyst expectations and the street coverage. 7 buy calls, no holds, no sells, 27% upside from here. I mean, difficult to catch anything incorrect here except the fact that there's slightly limited coverage, but it's a 10,000 crore market cap company, and therefore we have to give them that. The coverage is decent, and 27% upside looks good. Therefore, let's sum up the ratings very quickly. Let's look at the income statement, neutral. Cash, the balance sheet, thumbs up. Cash flow, neutral. Return ratios, thumbs up. When you're looking at all of the other metrics, that's how it stacks up. It gives us a 6 out of 8, quite healthy, with no thumbs down on this one. So WABAG, WABAG, that's the rating it gets. Let's bring in Rajiv Mittal, Chairman and Managing Director at WABAG, WABAG, to talk to us about what to expect going forward. Good morning, Mr. Mittal. It's good having you here. I want to start off by asking you the most pertinent likely question. Does cash flow sustain in terms of cash flow to EBITDA? Is there a number that y'all are targeting going forward? And is this only because of government contracts? And with that shift in preference towards private contracts or industrial, does that mean that this will come down?
Good morning, Harsh, and good morning to all your viewers.
Good morning, sir.
Thanks for having us on your show. See,
pleasure,
cash has been our priority since we have adopted a new strategy called Riddhi, and our focus has been on cash, no more on the top line. Yes, profits are important, but profits, as you rightly said, converted to cash is most important. And that's the trend we are seeing for the last 3 years. And even if you see the last year, our cash generation was far higher than the profits we have made. So your question of how much you want to convert from the profit to the cash, we would say we would like to convert everything what we earn into cash. That shows it's real earning. It's not only a book profit.
Okay, so that's the outlook that you're giving in terms of cash. I just want to understand even the working capital picture that we are looking at. Now from FY24 to 25, while we have seen a reduction in terms of where the working capital days are concerned, just want to get a clarity in terms of where the sustainable range is what you're expecting. And also with the shift to now moving from municipal to industrials, would that further aid in that working capital management that we are looking at, Mr. Mittal?
See, generally your question, Anushi, is right, and that is where we are working on. We want to reduce the working capital, and that one big reason you have seen in the last 3 years, we have been saying we will take less of C. As an EPC contractor, we want to do more EP. Being a technology company, we want to focus on technology and engineering, and not so much of construction. That's not our domain expertise. We used to always subcontract and let it out, and it was a pass through for us. If you want to do a big top line, yes, C is important, but we said C is not important for us. As we said, cash flow and profits are important. Hence, for us, this working capital will come down. 2 reasons. One, you said industrial. I would add, along with industrial operation and maintenance contracts, cash flows are generally better, and also international contracts where we have multilaterals and LC driven contracts, and these payments are generally not getting delayed compared to some of the Indian government payments get delayed, but this payment don't get delayed. So we expect going forward this working capital to further come down.
So by how much? Give us that visibility, because when I'm looking at your current trade receivables, it's sitting at around 2,000 crore. Any amount of unwind here, and sir, I'm being very genuine here, any amount of unwind here in a big fashion could materially impact your stock price, and therefore trying to understand what's the visibility on it.
See, Harsh, you must know this. We run a fairly spread out business in 25 countries, and most of them are emerging world. So there is always going to be a project mix which is going to decide our receivable, and also it is important that whatever we build, especially in the last quarter, because of this multilaterally funded projects, generally we don't collect it. It's not a consumer business, it's not a cash and carry business. There is a complex EPC business which we do work, we do the measurement that side, we get it certified, then there is an approval process, then it goes to a multilateral agency either in Washington, the World Bank, or in JICA, Japan. So it takes about anything between 60, 75, 90 days to get this cash unwind. So there will be always a working capital. Question is how much we can bring it down. So if you tell me to put an absolute number, it will be unfair that I give you absolute number, but the trend would be coming down from 110 days.
That's a fair enough understanding that we are seeing. But you emphasized on two areas. Firstly, the share of international business going up. Along with that, even the industrials that is expected to have an uptick, along with O&M having more focus-based contracts in that space. Just want to get a picture in terms of how the margins differ here, which are some of the key geographies from wherein you're seeing these orders flowing in for the business.
See, one thing is clear, the O&M business gives us the best margin because it's a service model, it's purely service, is not affected by commodity price escalation. So O&M is the best margin contracts. Yes, it's not a top line business, but definitely a bottom line and a cash flow business. Next, India and Middle East and Africa. They are giving the next best margins. And last, as we expect Europe to give the least margins.
So with regard to O&M, will that pie increase? What is the margin number there and what's the margin number both? Give us geographic margin numbers if you can give us that perspective. Even a broad level would help.
See, O&M, we have a declared visibility and we had given last year a medium-term outlook which is for 3 to 5 years. We stated that outlook that our O&M should be at least 20% of our company top line. Today, what we closed in March 25 was 18%. So we are not far from our target, and with the kind of backlog we have on O&M with long-term contracts, I think it's very possible that we will even exceed 20%. And even on the geographies, I think Middle East and Africa is going to be a next growth engine. So we would clearly see this cluster, Middle East and Africa cluster, to almost compete with India cluster, which is today at almost 70%. I think over the next 3 to 5 years, both would compete with each other to reach almost an equal contribution to the top line.
Okay, just a small follow-up on that, we are seeing a lot of tensions in the Middle East. Even if you take Saudi Arabia and picture, the capex for the year had been overall on the muted side. Are you seeing any concerns on funding or, in terms of orders coming in from that region?
Not at all. Not at all. Repeat. Because our markets are in mainly GCC and in Africa. Now, in Africa, we would go only for contracts which are multilaterally funded. Even if there's a disturbance, the multilateral funding doesn't slow down, neither stops. You take an example of Bangladesh. We had some disturbances in Bangladesh. We have a contract called Pagla in Bangladesh. This contract, yes, for a few months, when the disturbances were at peak, it slowed down, but now it's back on track. It's funded by World Bank. So we don't see that. And even in Middle East, if you have those disturbances, we don't think that contracts will slow down. In fact, the oil prices will go up and there will be more affordability for GCC countries to invest in infrastructure.
So how long is the O&M contract duration typically?
Harsh, this is the best news. I think every year we see these O&M contracts have been going up. Earlier, we used to get 3 to 5 years, then 5 to 10 years. Now we are talking about anything between 10 to 20 years. Take an example of the largest desal plant we are executing in Chennai, which is Asia's largest desal plant. It has a 20-year O&M after we finish construction.
Okay, and Mr. Mittal, also want to ask you in terms of the revenue growth picture for the next 4 to 5 years. Now, while in the last 4 years, we have seen the order book to build ratio has remained very strong. It's a 4x ratio that we are looking at. It's the revenue CAGR which has been comparatively muted. So going forward, what is the kind of growth that you expect over here?
Anushri, we have given this outlook already last year. You may have it. We have clearly said we will have a growth of almost 15 to 20%, and that is the outlook we have given for next 3 to 5 years. So don't expect that every 20% will happen this year. Give us 3 to 5 years, we will move towards 15 to 20%. We are already getting 15% up last year, and going forward we will further try to improve this ratio. Again, I said revenue is not important for us. Is the bottom line, is the cash flow, is the valuation, is the working capital reduction. These are the important parameters. Revenue is just an outcome of what we execute.
Okay, thank you so much, sir. Mr. Mittal, this has been an absolute pleasure speaking with you and getting this perspective. And we completely appreciate that revenue is not key. In fact, if you go back and rewind this conversation, we started the show by saying this. So, sir, point well taken. We've driven that home with the viewers as well. Thank you for coming in and speaking with us.
Thank you for having us. Bye-bye.
Bye, sir. So, okay, so it's interesting. I want to just pull up one picture. The FY25 breakup in terms of the split, EPC to O&M, municipal, industrial, and India versus rest of the world. If you can quickly pull that one up. This is that number is on the basis of FY25 order backlog. I want to repeat this. This number is FY25 order backlog. It's not the revenue mix. We stand corrected here. So just want to quickly put that on record. But out of time on this edition of KYC. Thank you so much for joining us. This was an interesting conversation and hope you all found it as interesting.